Hi, and welcome to the X22 Report Spotlight. Today we have a returning guest, Wolf Richter. He's the creator and owner of WallStreet.com. We had Wolf on back in May of 2015, and I am very happy to have him back on the X22 Report Spotlight. Welcome back, Wolf Richter.
Thank you, Dave. It's a pleasure being back.
Thank you for coming back. And last time you were on, we talked about unemployment, which was at 5.4%. We know it's at 4.9%. We talked about the housing bubble. And I wanted to start off with the housing bubble. And we're starting to see the housing market, not just here in the United States, but around the world in different countries starting to crack. Are you seeing the same thing occurring in the housing market where things are starting to decline at this point?
Yeah, the housing markets are very local. So you have some places where the declines are already very visible, and other places where everybody is still extremely enthusiastic. And so it goes city by city, and that's how the last housing bust progressed. You know, it started in some places, and in 2005, 2006, then in the mid-2006, the national average peaked, and it was declining from that point on. In San Francisco, for example, the peak didn't occur until November 2007. So this isn't something that happens across the nation in all markets at the same time. It goes city by city. And, one of the biggest housing bubbles ever is in San Francisco, right here where I live. And this is starting to look really, really bad. We have a historic building boom going on. 62,000 new units are going to come online here in the next few years. They're all high-dollar units for rent and for sale. We have a tech bubble that is now grinding to a halt and deflating. We have startup valuations that are being halved at every new fundraiser. So we're having two forces that are going to collide with each other. One is the decline in the startup bubble, which is huge in San Francisco, and the other is the arrival of new units. And you'll see that these new units will start lowering their prices and rents to attract people, and that will ricochet through the entire housing market. So this is, and everybody's talking about this now. I mean, this is no longer a secret. When I wrote about these issues a while back, a year ago, everybody thought I was crazy. Now this is here. Rents have already declined by about 5% since last summer, and housing prices still really, I mean, they go through seasonal patterns, so we don't really know until a little down the road. But we're seeing the negative side effects of all of this starting to spread around in San Francisco. Now, Houston has a problem already through the oil bust. Dallas is still booming. So, it's not in every city, but we're on the verge of seeing enough big metro areas getting in trouble.
I agree with you. I see it in upstate New York, and I look at the real estate market quite a bit, and I do see many areas where people are trying to sell their homes and they're lowering their prices very slowly, trying to attract the people, and they're continually doing this, and the houses are staying on the market longer and longer, and it's getting more and more difficult for these people to sell. But in the US, we see it happening in different areas, like you said. Do we see problems in Canada and in Australia and in any other place around the world?
Yeah, the two countries you just mentioned, Canada and Australia, probably have the most magnificent housing bubbles ever. And in Canada, it's just been phenomenal. Even during the financial crisis, when housing collapsed in the United States, it just dipped a little bit and then continued to soar. Now, what has happened in Canada is that the market bifurcated. So you have still a very strong housing market in Toronto and Vancouver, and it's already starting to decline in the other cities. So the housing bubble there, overall numbers, because of the weight of Toronto and Vancouver, are still strong, but the larger parts of the cities that are in Canada are seeing declines. And this is how housing bubbles burst. Yeah, they burst at the margins, and then they work inward. Toronto is an incredibly strong market still, and it has a lot of foreigners, especially Chinese investors coming in and buying up units. So this hasn't turned around yet, but it has in other cities. In Australia, the two primary cities, Sydney and Melbourne, still have very strong housing markets, but in other cities, prices in some of the smaller towns, prices have actually collapsed in the mining towns. Australia is going through an incredible mining bust right now, and the oil and natural gas bust too. So they've gotten hit very hard. But in Sydney and Melbourne, housing markets are still strong. So we'll have to see how that works itself into these cities. In Australia, particularly, the big issues of the banks, the four big banks, are heavily exposed to housing, and they make up about 50% of the Australian stock index. And so, I mean, and people have been shorting these banks, expecting a major crash, and of course that hasn't happened yet. So the banks are still doing okay, but the 50% of all mortgages now issued are interest-only mortgages because people can't afford a regular mortgage anymore. I mean, it's a classic pattern of housing bubbles reaching the peak.
Back in, was it 2007, 2008, when we had that subprime housing problem, which kind of created the whole entire crisis. Today, we see the same thing in the auto industry. And you wrote a couple of articles about that, about these subprime auto loan problems. Can you just explain a little bit to the people about what is happening in the auto loan industry?
Right. So subprime borrowers are those with credit scores of under 620 or under 600, depending on who's looking at it. And they have a right, and then a right, they have a need to own cars just like everybody else in the States. You have to have a car in most places to go to work. And so there's an industry that makes that possible. And there's nothing wrong with that. I think we have to make room for subprime borrowers to be able to buy cars. And but it's a high-risk borrower, so they're more likely to default. So everybody wants to make more money on those loans because they're going to take bigger losses down the road. What you end up doing now is that some of these deep subprime borrowers, deep subprime meaning with credit scores under 550, they're now paying over 20% interest on these cars, and to make these loan payments even remotely possible for these folks, they stretch them out over 7 years, which is a very long time for a car loan, and sometimes even longer. And that's been going on for a long time. And last year we had about 24% of all subprime, of all loans, of all car loans being subprime. So that's a lot. It's a quarter, or close to a quarter. This year they're defaulting. So now we have a delinquency rate of nearly 5%, so that's close to what it was during the peak of the financial crisis, and rising sharply. In the financial crisis, it peaked at 5.4%. Now we're at 4.7%, just a hair below. The default rate has jumped to 12.3%. And here's the thing with car loans: they become delinquent first, and after they've been delinquent for 2 or 3 months, and the delinquency is not cured, they go into the default basket. They declare default, and they stay in default until the vehicle is repossessed and the losses are accounted for, and then they become a write-off. So they go through these 3 baskets. They go from the delinquency basket into the default basket into the write-off basket. And so they stay longest in the default basket. So the default basket is bigger, and but now they're at 12.3%, the default basket. So which is the highest since December 2010, and so this is starting to look very much like the auto problems during the financial crisis. Now, subprime auto loans are not big enough to topple the major U.S. banks. We're talking about $200 billion approximately. So that's not like subprime mortgages. But there's specialized lenders that do that, and they're thinly capitalized, and they're starting to have trouble. And some of them, like Santander Consumer Finance, which is a unit of the Spanish bank, their stocks have collapsed. Others are private equity owned, and their bonds are in trouble. A lot of these subprime loans are packaged into asset-backed securities, and with the loans being collateral, and the collateral is now defaulting, so these asset-backed securities are getting in trouble, which shows investors that this is not a good deal anymore, and they start buying them. And so now what you will see is that the subprime lending will gradually dry up, and it will make it harder for subprime borrowers to borrow money to buy the car they want to buy, and it makes it harder for the dealer to sell those cars, and you'll see the ripple effect in total car sales. And I think that's where the bigger damage lies. The car sales have been booming. It's been one of the only booming sectors in the United States, and subprime is starting to eat into it, and we've already seen some declines in sales so far this year, so this is going to be tough.
So would you say that we have a housing bubble that's falling apart now, an auto loan type of bubble that is going to fall apart at this point? Is am I correct in?
Yes, you are. The auto loan, but I would rephrase that a little.
Okay.
The auto loan bubble makes the auto sales bubble possible. We've had record sales in the auto sector. I mean, they've been huge last year, and the auto loan bubble makes that possible. And so the bigger impact for the U.S. economy will be on auto sales, and that's manufacturing, that's service, that's insurance, that's all kinds of the auto sector in the United States is big. I mean, you're talking about a major employer. It contributes a lot to GDP. It's about 20% of retail spending. I mean, this impacts all kinds of things. Okay. So that's the part I'm really worried about is auto sales. Unless the subprime will take down some smaller lenders and investors will lose some money, but the impact on the U.S. economy is far larger than that.
Let's move into negative interest rates and the war on cash. We understand that the Fed increased interest rates by 25 basis points,
right?
While Europe is in negative territory. Japan announced they're going to negative territory. Why are we seeing the differences in Europe and Japan compared to the U.S.? And we are starting to hear the Fed talk about negative interest rates at this point. What is your take on all of this, and why are we going negative?
Yeah, I'm not sure that the Fed has been talking about it, as you said. I'm not sure that they want to go that route, actually. I think they would like to get away from this. And we have seen negative interest rates tear up all sorts of things. They make the pricing of risk impossible. So you get all kinds of distortions. Banks can't really pass negative interest rates on to their depositors. So they have to pay. Negative interest rates mean the banks have to pay the central banks for their reserves. So they have to get the money from somewhere. If they can't get it off of the savings accounts, they'll get it from fees and higher interest rates. We've seen that in Switzerland. Now, mortgage rates actually went up since the negative interest rates were installed in Switzerland, because banks have to make some money somewhere, and they can't make it on deposits, so they're making it up on mortgage rates. And that's a total counter effect to what was desired. So now in Switzerland, you have higher mortgage rates than you had before. In Germany, there are all kinds of distortions about how banks are trying to dodge negative interest rates. Now the smaller banks are trying to hoard cash in their vaults, in order to not have to deposit the money at the ECB, where they would be charged for it. So they now have, and that's the banking association that is coordinating this in Germany. They have checked out insurance rates. So insurance will go up for the bank vaults, and they have figured it's cheaper to keep that money in cash, in euro bills, in their vault,
Mm.
in large numbers, instead of sending the cash to the ECB. So they cause all kinds of distortions. And I think and in Japan, where I'm just writing about this now on my website, the article will be posted later today. The Bank of Japan, with these negative interest rates, has killed off the money market fund. So the last 11 fund managers that still have money market funds are shutting them down right now. It killed the entire industry, because you cannot have a money market fund that every month starts loses principal, and that's what you'll get. Your every month you'll break the buck. And so negative interest rates have a really nefarious impact on all kinds of things, and I think the Fed is seeing that, and I think they're just really trying to somehow get back to normal, because this is just an absurd situation.
Yeah, even the Biz came out and was warning about negative interest rates and how it's not really helping the global economy.
Right.
And we've heard that, I think it was yesterday or day before that, they
Right.
came out and said that. Now, with all this happening all at the same time, you wrote an interesting article about corporate default rates, that they've jumped past the Lehman moment. And are we at a point where things are back where we were back in 2008?
Yeah, this is interesting. Yeah, in 2008, when Lehman went bankrupt, there was panic in the air, and today there's no panic. Everything's calm, but at the junk bond front, where these defaults are taking place, the bottom is falling out, and yields on high-risk junk bonds, so those rated CCC or lower, have jumped to 20%. So, and there's a lot of that debt out there, and these companies that have issued these bonds can no longer roll them over. They can't afford to go out and issue bonds at a yield of 20%. It's too expensive here. And so when companies in that category have to when they have a bond issue maturing, and they have to issue more bonds to pay off the old bonds, they run into the problem that they can't do it anymore. And so now you're getting all kinds of defaults in that sector. And it's not just oil and gas. About half of them are oil and gas and metals and mining bonds, and the other half, you've got communication. iHeart Communications, for example, is one of them. You have Sprint, you have all kinds of other fairly large companies in that group now, with the bonds falling apart, and the default ratio is back where it was after Lehman. So Lehman went bankrupt in September 2008. So now we're where the default rate was in October 2008, November 2008. So this was after Lehman blew up, and it's calm. This is the thing. There are no bailouts in sight. The Fed's trying to raise interest rates. The stock market is doing fine. It's going down, but it's doing fine. It's not collapsing like it did back then. And so what this tells us is that this will keep getting worse and worse and worse. This is just the beginning, and nobody's taking it that seriously.
I think the silence is scarier than when they came out and said we have these major problems, because it seems like they're just ignoring and just pretending that all this doesn't exist. What do you think about banks like Deutsche Bank, where they're having problems, and the banks in Italy, they're having problems also? Do you see this all part of the same problem?
Yeah, banks are essentially a black box, and we know that from Lehman and from other banks that have collapsed. You don't really know what's going on in a bank until it collapses, and you start sorting through the debris, and you see just how much destruction and losses have accumulated that on the surface didn't show. So that's what everybody's worried about. Nobody really knows what's going on at Deutsche Bank, but everybody's worried, and nobody is. Deutsche Bank is not going to be allowed to collapse like Lehman.
Mm-hmm.
Yeah, that's not going to happen, and you will have the German, even if it violates the rules, you'll have the German government come in, and probably the ECB, and they'll prop it up somehow. Now there will be losses. The new regulation is that stockholders and some bondholders will get bailed in, so they'll lose a big part of their investment or all of their investment. But Deutsche Bank is so huge and it is so essential to the German economy that it will not be allowed to topple, even though investors will be allowed to take big losses. Now that's what's going on here, and investors have been taking big losses at Deutsche Bank, and then the Italian banks the same way. So we don't really know what's in those Italian banks. The Italian banks have a problem with bad loans that Deutsche Bank probably has less of a problem with. They have, you're looking at about 200 billion euros in bad loans there. That's the official number. But nobody really knows because they've been hiding these bad loans and they've been ignoring them and shuffling them under the carpet, and so even the bank regulators don't really know. And the banking sector in Italy is they have a lot of smaller banks, and so they do whatever they want to in a sense, and so you don't really know how bad it is, except it's a lot worse than what we think it is. Right now we think there's 200 billion euros in bad loans in the Italian banking sector, and it's probably a lot more. And so they've been getting bailed out and propped up and bailed in Italy, and it's a continuing crisis in Italy with their banks. And they, in the United States, to their credit, there were some efforts made to clean up the banks and shore up the balance sheets and get rid of the bad loans and deal with them. That hasn't happened in Europe to any major extent. They really haven't gone through that step, and that's what's hounding them now. So I think there's a potential for a banking crisis in Europe.
Do you think at this point that we're headed into a bear market, or are we in a bear market?
Well, it depends how you define it. A lot of people define a bear market as when the index is down 20% from its recent high. So by that measure, we're not in a bear market right now in the U.S. The Nasdaq got close to it a few weeks ago. The Russell 2000 was steep into it, but they have since recovered quite a bit. So we'll see. But and by that definition, we're not in a bear market today. But the stock market high was in 2015, in May 2015, and we're back where we were in 2014, early 2015. So this is not a healthy stock market, and it is still overvalued by a huge amount. So I think there's a lot more pain. I think if what it looks like to me, I think you're looking at many years of subpar performance. You may have a year of some gains followed by a year of some losses, and with a net downtrend for a good long period. I mean, a lot of people are waiting for this very tradable crash that's going to just suddenly happen, and this could happen, but that's not in my scenario, and I think it's going to be painful and terrible for a long time, and I don't think there's going to be a real tradable crash there.
So you think it's going to be a slow, drawn-out type of collapse or crash type of scenario?
Yeah, I think this.
Go ahead.
Yeah, I think this is exactly it. Yeah.
So have we started the pain already, or is this going to start? I mean, is it going to be very noticeable? Like, one day we'll wake up, it'll be, 500, 1,000 points. A couple months later, another 500 points down. Is that what you're talking about?
Yeah, and of course, a lot of stocks have already been completely eviscerated. Yeah, that's the thing that's underneath the surface. You have stocks that are down, a lot of stocks that are down 60, 70, 80, or 90%. And smaller stocks, and there's not just a handful, there's hundreds of them, or maybe thousands. Beneath the surface, there has been an awful lot of bloodletting, and that kind of damage is usually not temporary. They'll bounce like Chesapeake bounced 200 something percent in 3 weeks, from $1.56 to 5.50 or something, and then yesterday it plunged 18% again. So yeah, those are the energy stocks, but it's not going back to $35 a share. So these bounces are temporary, and I think it gradually will work its way to larger companies, larger stocks that are considered healthy today. You have revenues that are declining. Last year was the first year since the financial crisis that revenues for all corporate entities in the United States have declined. And by fairly good margins. Our earnings are declining. I mean, these are indications that we got a real problem. We have a stock market valuation that is priced way beyond perfection. So I don't see these two in line at all. I think there's going to be an adjustment, a big one, and it could drag out for a long time.
And will that bring us into a depression, or when this happens, what is the everyday person, going to experience? Are we moving into a recession? Is it a depression? Is it a collapse of what we know today?
Yeah, I'm not a fan of predicting depressions. I've never been through an actual depression. The financial crisis, some people call it a depression, other people call it a Great Recession. We've been through that. I think we're facing a recession. And the financial markets, when they collapse, that doesn't mean there's going to be a depression. So the financial markets are somewhat separate from the real economy. And we have seen the financial markets soar over the last 7 years, and the real economy has languished. So, they're not necessarily linked. So I can see that the financial markets will trend down over the next few years, with the actual economy continuing to be languishing, and maybe falling into a recession, but not a depression. I don't see that coming.
And what happens in the beginning of the our interview? We talked about the housing bubble, and if that spreads rapidly, what type of an effect will that have on, and the auto loan problem? What type of an effect will that have on the economy in general?
Yeah, I think this is pretty much guaranteed, that if the housing market in the United States starts hissing hot air, and if the auto sales bubble is starting to hiss hot air at the same time, we're going to enter a recession. Those were the two big, strong sectors that have held up the economy so far, and including construction. Now, construction is very intense on the economy. So if construction starts slowing down, and in San Francisco, when I look around, I mean, those new high-rises popping up left and right. So when that construction boom starts slowing down, and auto sales start slowing down, I think we'll have good materials for a pretty good recession.
Wolf Richter, thank you very much for being on the X22 Report Spotlight. How can people take a look at your work?
Yeah, all my stuff is on wolfstreet.com. So Wolf Street, like Wall Street, only my name, wolfstreet.com. Everything's for free. You can just read it there. I have some other authors on it with some different points of views. So it's all on wolfstreet.com.
Wolf, once again, thank you very much for being on the X22 Report Spotlight.
Thank you, Dave, for having me.
Thank you.